Hello and welcome to episode 219 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome to the show. How you doing?
Yeah, I'm good. I'm absolutely buzzing because if anybody listens to this podcast, they will know that I'm a season ticket holder at Tottenham, and Tottenham probably pulled off one of the most amazing. Was it a comeback? It was kind of a comeback, really.
It was a bit of everything. It was a shock, and then it was like a well deserved, and then it was a bit of luck in the end.
It's been described as one of the best football matches in a long time, and it was so exciting. Obviously, of course, I'm talking about Tottenham knocking Man City out of the Champions League and making it to the semi-final, which I will be going to. And if you follow us on Instagram, then you would have seen me cheering that fact. So yeah, I'm buzzing, Andy, and yeah.
Well, that's good. We've opened up 2 podcasts 2 weeks in a row now with football. So my promise to you, dear listener, is that we won't do the same again next week. I do feel like we're alien. But the thing is, our teams are doing so well, and it very rarely happens. We're getting excited.
I think people like us to be happy, though. I think people like the idea that we get something out of life other than just talking about money. Yeah. So no, everything's good.
And I've spent so many years not getting anything out of football with being a Watford fan.
No, but it might be your time. But on a positive money-related story, I've taken some time off in the last week or so because it's Easter holidays and spending time with the family and the children, and we've done some great things. We went to the London Aquarium, but did that for free because of Tesco club card vouchers. That's not a plug for Tesco, that is just a fact. That was nothing to do with me. My wife organised all of that. So there's some great deals out there on an Easter weekend, and it's good to get away and spend time with the children. And we went to one of the National Trust places in Sevenoaks. So we joined the National Trust, something I've been threatening to do for years. Basically, if you go to 3 different places within your year, you get your equivalent of your money's worth out of it. So it's a bit of a money-saving element, which isn't my thing, but it seems to be at the moment.
Good stuff. Well, what have we got coming up on this week's pod then?
Right, there are 3 pieces. We've got a piece which Andy's going to lead on later on, which is to do with fake reviews, which is something that is an irritant to most people, but there's been news about the number of fake reviews out there, so we're going to help you how you navigate those things. One of the pieces, the investment piece, is going to be around fund switches. Now, we did something recently where people were asking me about share classes and stuff like that, but I was pondering when I was walking along the road that there is a definite process I apply when I make a change to my portfolio, which I've done to my 50k portfolio on 80/20 Investor in the last week or so. And there was a process I tend to follow, so I thought I'd share that. It's not saying it's the Bible of processes, but it's the things I do and double check before I make a decision and before I enact any switch. And the last piece is about whether you should overpay your mortgage, or more importantly, things to keep an eye out for.
Good. So which piece are we going to start with?
Let's start with the investment piece. Now, when you've got a portfolio of funds, typically most people have unit trusts. So I'm focusing more on unit trusts. And somebody asked me once, why do I use unit trusts in my portfolio? The simple answer is because most people have them. So I want to show people how to use them, even if investment trusts and ETFs are, on the whole, much more flexible. They can transact far quicker. There aren't the delays there are with unit trusts, but there are other issues, and I talked about that in a recent podcast. So
just briefly on that, do you think in time that will change? Because if it is more flexible and it is easier and everything else and cheaper potentially to do ETFs, do you think the tide will change eventually?
Yeah, I think a tide will change. More people will use ETFs. I think the fund platforms are expanding the breadth of investments they could hold. For example, Fidelity never used to allow you to have ETFs and investment trusts and shares and things like that. They're now realising that people are aware that the other types of investments exist, and they're driving costs down. But on the flip side, the prevalence of ETFs and the low costs associated with them are driving down the costs of unit trusts, and in particular actively managed ones, the ones that have a fund manager. So all of this is just driving towards lower costs for investors, particularly DIY investors, which can only be a good thing. So I just want to run through what do I do when I sit down and want to make a change to my portfolio. Now, the first thing I don't do is I don't market time. And by that I mean I don't sit there and think, I think now would be a great time to sell or buy in the market, because the truth is you'll never get it right. In the long term, you think you'll be able to time the market, and then fear or greed, so some emotion, will cause you to make a bad decision or an ill-informed decision. And over the long run, you'll probably lose as many times as you make money. So there's not many people who actually make it work over the long term. There's a lot of luck with timing in making switches. And I know that because I've had occasions where I've done a fund switch. And again, it's a drawback of unit trust where there's a delay when you move out of one fund into another, because there's a sell instruction and then normally a buy instruction afterwards, but there's normally a day's delay because of the pricing. I've had the market leap by 1%, 2% in a day because of something macro related, something that was unforeseeable, and I've therefore lost out and it sent me back. But equally, I've had days where the market, I've made fund switches and the market has tanked and I've been in cash temporarily and benefited. So we'll come on to that, whether you can judge whether now is a good time or when is a good time to be out the market, and whether the market could move against you or for you, whether you can stack the odds. So I don't market time. What I tend to do is regularly review my portfolio, but at periodic time frames. So normally for 80-20 investor, I have to do it monthly just to give people insight into what I'm thinking, because a lot of the time you make a decision to do nothing, and that is a decision in itself when it comes to investing. So what I tend to do is once every month, 6 weeks, I will sit down and look at my portfolio, and often I will just sit there and talk about the performance, what's happened, or make odd changes. Now, one thing I try and do as a rule of thumb is trying to change as little as possible, because if you do wholesale changes, you can chase your tail. But the issue, like I mentioned just a minute ago, where the market can move for or against you, if you only move part of your portfolio and the market moves against you, so it rallies while you're out of the market and the transaction's going through, it will only impact you in a small way. Equally, if it goes the other way, obviously conversely, and it would benefit you, you don't make as much money, but what it does do is it means that you're not doing massive changes. So it's more like weeding and pruning rather than digging up the garden and starting again. So I try to keep them to a minimum, and it's only if I think there's a better opportunity elsewhere that I change. Now, I don't market time, like I say, but I keep an eye on the VIX, so the VIX, the VIX, the market fear gauge, and general levels of volatility in equity markets. Now, there may not be a particular volatility measure I look at, but I will look at the movement of markets over the previous sort of weeks and particularly the previous days to see if there are any swings going up and down, because when markets are volatile, they're much more likely to move against you to a point, because you can't predict the future. So you can have a market be very volatile one day but not be very volatile the next day. Now, I did some research on this for 80-20 investor members, and I will give, this was a while ago, so I'll give a bit of it away on the podcast without doing a disservice to any 80-20 investor members, but it gives you an insight into the types of research that I carry out, is that I looked at what would happen if the market fell one day and you therefore made a switch the next day, and compared that to if the market had rallied on a particular day and you then decided to sell. So could you stack the odds in your favour if you picked a particular day to make a switch after the market had dipped, for example, so if it's a falling market, is that a good time to therefore switch to make sure that the market did move in your favour, i.e. kept going down, so when you were in cash you benefited? And the research showed there wasn't a strong correlation between the two. So if you make a switch, if the previous day the market moves had been downwards, it didn't stack the odds significantly enough in your favour that the following day would be downwards as well, so that you would benefit. And so equally, if the market went up and the market's rising, you might think, I don't want to get out or make a switch because the market's going up. It didn't mean there wasn't a correlation or strong enough correlation or significant enough that the next day would do the same. Because don't forget, markets go up and down all the time. So you can't time in that regard. I mean, I also looked at what would happen if you looked at the market, how it moved a couple of days before, so a few days in a row. And again, it wasn't significant enough to say that conclusively, if the market's fallen for a few days, now's the good time to make your switch because it will be in your favour. And the only thing I would say that suggested that it started to make an impact was if you saw swings in the market of 1% or more. So if for 2 days in a row the market moved up or down by 1% or more, which is quite a move in a single day, then that would suggest, I mean, when I did this analysis, I was looking at the FTSE 100 in particular, so I was pretending I was trading on the FTSE 100. So if the FTSE had moved up or down by more than 1% in a day for 2 days in a row, that suggests things were volatile. if you avoided, therefore, trading until things settled, then it started to be in your favour to do so because markets were too volatile and you're more likely to be caught out. And that goes back to my view of just looking at markets generally and getting a sense, do you think it's volatile? Again, you can't predict the future, so you have to just sometimes just suck it up and hope for the best. Now, I do sometimes focus on market moving events. So if there's something crazy going on, like Brexit the other week, potentially we could have had a no-deal Brexit, although I know it was very unlikely in some ways, but there was still the legal default that we could have done, then that would have been a huge event in markets. So I was looking to make some switches anyway, and I waited till we had some clarity over the extension, the delay of Brexit until October, so I could go, right, I can make my switches. Because not only is it about equity markets moving, it's about currency markets moving. So you've got that dual thing, because we'll see if the pound's whipsawing up and down as it has been, then equity markets could be completely flat. But if the pound suddenly jumps up and down while you're making that switch, they impact the price of overseas assets. So if they didn't change in value notionally themselves, then the currency conversion would mean that their value would have changed. So it's that kind of thing that you also want to keep an eye on. So currency, keeping an eye on the pound, that would be another thing I would be watching, just to see if there's anything crazy going on. Now, I can't predict the future, but if I know there's going to be some key market moving events in a given week, I'm just about to make a switch, then I might delay doing so because it could cause something to move. So there was, like I said, the Brexit delay, or we had the Fed announcing something the other week, and they all happened on the same day. It just seemed to me to make sense to wait one day later, and of course I did, and on this occasion it worked because the market settled down immediately and there was a nice flat period. So it's a bit like, you don't want to launch a boat in a choppy sea ideally, do you? You'd rather things were nice and calm.
On that, would you ever consider, if you were unsure whether it was going to go up or down and you really wanted to do something, would you ever just consider to moving into cash just to kind of just as a fail-safe, just to keep it there?
The other thing you could do is, if you moved it into cash, then yeah, if you're uncertain about markets. Now, part of my portfolio went into cash at the back end of last year, which did smooth out the volatility, which was a real positive. But of course, when the market's rebounded, it's a drag. So it's the risk return that you get. So you have to, opportunity cost is the phrase. So yeah, you could do that if you wanted to. But in terms of switching, I think that if you start to, you'll then get into the market timing. If you go, right, I'm going to move into cash, and then I'll wait till I can move into the next investment, there is a danger that you could just never move and you'll just get stuck.
You're still waiting for the perfect time, and you've got the same problem then.
Yep, and life's never perfect. Now, if you want to know what sort of, if there's any potential market moving events, like big ones I'm talking about, then listen to the Midweek Markets podcast, which I do every week, where I talk about some of this stuff, about stuff that's happened and things to look out for.
And of course, those midweek markets, Damien, they populate into the feed already. But if you're interested in actually seeing how Damien delivered those, and you want to actually see Damien's face, you can, of course, go onto YouTube and search for Damien's Midweek Markets, and you'll find Damien doing that on video.
Yeah, and you'll see my nice Money to the Masses t-shirt. On that note, slightly off topic, we're doing more on the mugs. We're doing a couple of a mug giveaway on Instagram. So we're giving away 5 more. And what we've done is we created a mug hall of fame. And I'm veering off topic, but bear with me. A mug hall of fame, so that we know everyone who's had one of the mugs, and they are priceless. They're very rare. They're very sought after, and you can win one of the 5 that we're giving away because we hit 1,000 followers on Instagram. So go follow us, boost that number. It should be near 10,000. I'm not sure why it's not, but what we've decided is we're creating this hall of fame because we know everyone who's got one. We're going to put people's names up on a wall.
Yeah, you're literally going to get your mug on a mug hall of fame.
Yeah, and we'd love mug shots of people who win them, and we're going to start giving them away for people who do things that are worthy of being in the hall of fame. It's not just competitions, we're going to give one away. If for some reason you do something that helps, that might be awesome about your finances, helps promote the Money to the Masses cause and what we're doing.
If it's a really good question that moves us off into a direction where we end up doing some sort of a campaign, make it mug-worthy. That's what we're saying.
Make it mug-worthy, and we're going to start giving them out. And you will appear in the Money to the Masses Mug Hall of Fame. So
if you want to get in touch on that, email Damien at moneytothemasses.com, or of course you can email me as well, Andy at moneytothemasses.com.
And if you feel like you deserve one already, you just tell us.
Yeah.
We can only say no.
Yeah. which is likely if you're just on the scrounge, but you never know. Cheekiness will get you far.
So going back to the question, another point, I did some research for 80/20 about the best days of the week to allow for that change, that delay in the transactions, because you're normally out of the market for at least one day. Was there a day with unit trust, the best day of the week to do your change statistically? And there was. I'm not going to tell you what it is. I'm going to tell you what the worst day is so you can avoid that. And that was Thursday. So there you go. That's a free bit of research insight. But there is a particular day of the week that is statistically better to put a switch or to enact a switch. Now, moving on to what do I look for? I look at my portfolio. I look at how it's performed recently. I look at particularly how it performed in any downturns and see how it performs against its peers. Now, 80-20 Investor does that for me. I get that data and look at it. I look at the asset class and the asset mix, because overall, I also want to see how maybe UK equities are performing, not just the fund I might hold, how US equities are performing. So again, this is part of what Midweek Markets does. I talk about what's going on in the world. So at the moment, the German DAX has had a good little run in the last week or two. So I'm a long-term investor, but I'm just trying to get a view of what sort of macro trends are going on out there. And I put that as a backdrop. But I do look at 80-20 and I do take account of momentum, obviously, to see what's working. And I won't go at a hatchet job. Like I say, I try and keep changes to a minimum. But if I look at the new funds, what I look at is I try and work out why a fund has done badly, and that can be because I look at its correlation to other funds that have done badly. I'll look at the fact sheet. I'll then start to look at what the biggest holdings are, particularly in terms of sectors it holds. So could it be have a lot in technology, if technology is doing badly, or if a fund is doing really well, why is it doing really well? I try and work out why that is, because sometimes you can go and buy a fund and you might think it's going to continue doing well, but there might have been a particular set of circumstances that occurred in a given period of time. It might be a currency move, for example, rather than the equity itself. I try and work out roughly why I think it's outperformed any of the others by looking at that fact sheet, because you can see what the biggest holdings are and the biggest weighting in terms of sectors. You can therefore find others that have performed well alongside that and say, well, have they got a similar makeup? And if they haven't, you can start to isolate why. And then if I find funds that I like, I always go back and see how they do in a downturn, because it isn't just about shooting for the moon. We do want to worry about the fact the market could pull back. And now on 80-20 Investor, I look at one of the max weekly fall figures that we published, because I just want to see how it's performed. For anybody doing this themselves, produce a chart against a sector average or an index of similar type. So UK equities, it could be the FTSE 100 or FTSE All Share. Look at the dips and see how your fund has performed, and look at the volatility, because you'd rather have something that was less volatile but increasing in value. So the dream investment, just going up in a straight line. You aren't going to get that, but you can try and get as close as you can. Once I've chosen the funds, I look at the ones that I've compared them against what I've got. Is it significantly different enough? How did it perform against the one I'm replacing? If it's not significantly different over a period of time, we'll go back 1 month, 3 months, 6 months, a year. Is it really worth the change, given that you could be caught out if markets move? So you look at that and think, yeah, actually, it's starting to flatline. I'll give you an example. I held the Buffettology fund in my portfolio. I've had it for quite a long time, and it's held up because it has a slight value focus, not overly, but it does. It doesn't have a significant exposure to oil, and oil price has rallied significantly this year. So the FTSE 100 has a lot of oil stocks, so it's rallied alongside oil to a certain point. So it done well. But the fund in particular, the Buffettology fund, doesn't have a significant exposure to it. So it's kind of hampering returns. It had risen, but then it flatlined for a couple of months. And that was a trend that if the market is going to keep going where it's going, then it had done well in a downturn, but then it had lagged. But then if you looked at it, how it performed over a whole period of time in terms of the downturn, the downside protection didn't really outweigh what I missed out on the upside. So it wasn't a terrible fund, but there were better opportunities. So it's that opportunity cost. I then get the fund. I obviously do it on the platform that I use. I look at the costs involved. I look particularly at the bid offer spread. Is there a bid offer spread? Are there two prices on the fund, or is it single priced? If there's two prices, there could be a bid offer spread. Check. That's where the difference between the price is normally a percentage, and that is effectively like them charging you a fee to go in it. So I check what the fees are. I check there's no other fees, unnecessary fees that could surprise me in any way. And particularly, I might Google a bit of news around the fund to see if there's been any news about potential closures on the fund or anything like that, the one I'm going to go into. I check there's no switch charges on my particular platform, which I know there isn't because I use it all the time. And then when I pick the fund itself, like I talked about in a previous podcast, I'll always favour the cheapest version of that fund because a platform could have multiple versions of it. And I will tend to go for the accumulation because I'm a growth investor. If I have to pick an income version, then I would always reinvest the income and make sure that it does get reinvested by looking back at the data. If I do a transaction, I always try and do it before 11 a.m. because most platforms, the cut-off for the fund and the platform is normally 11 o'clock. If you do it after that time, then you're going to get let's say you do it after 11 o'clock on a Tuesday, then you're actually not going to be transacted until probably the close of play on Wednesday. So if you're going to do a switch, do it first thing in the morning. And one final thought is something along the lines that Andy mentioned, which is if I have cash in my portfolio, it can be that you could deploy the cash to buy an investment and sell the one that you've already holding. So rather than doing a switch from one to another, which is a sell instruction, and then you've got to wait for the next day to automatically buy the one you want, the platform takes care of that. If you had some cash that was sitting on the sidelines in your ISA, you could actually buy the new fund and sell the old one at the same time, so you actually wouldn't be out the market. That's an idea, but the thing you've got to bear in mind is that you don't know the final value of the units you're selling, so it'll be difficult to match up. But it is an idea. It means you are going to minimise the amount of time you've been out of the market. So there were some other tips in the previous podcast where someone was asking me about things about transacting, but that was my process of how I look at a portfolio and go through it and decide, is this the fund I want? I could do an extra piece another time on the statistics I also look at to pick the fund. If people want me to do that, then I can just write in. But that is the general process of sit down, how I go through it, how I actually transact it, when I transact it. And then I always save down a copy of the switch that I've made, because I have had in the past where the platform has incorrectly carried out my switch instructions, which sounds bonkers, but it does happen, and therefore you can show what you saw when you actually put the transaction through.
Find out how fit your finances are for free with Damien's Money MOT. With no registration required and no need to access policies or paperwork, you'll receive your own personal grade, together with a breakdown of where you should focus your attention, all in the time that it takes to boil the kettle. Crucially, you'll get to see how you measure up compared to everyone else, and even get your own tailored plan on how to improve your score. Simply go to mot.moneytothemasses.com. So sit back, relax, take Damien's free Money MOT, go to mot.moneytothemasses.com to get started, and reward yourself with that cup of tea afterwards. Good stuff. Moving on to mortgages. So should you overpay on your mortgage, or maybe there's some other options? We're going to go through the options when you pose that question.
Yeah, this came from something I was reading online actually, and it was talking about overpaying your mortgage, and it's about what to look out for if you're going to want to do it. Now, I'll go through this relatively succinctly because there's a couple of real key bullet points. Now, if you're thinking of overpaying your mortgage, the one thing you've got to think about is, do you have a cash buffer? So for the infamous boiler blowing up or whatever it is, do you have money set aside that you could use? There's no good overpaying your mortgage if you haven't got any savings of any kind. Now, depending on who you ask, it's 6 months gross or 6 months net salary is a good place to aim for. So build a cash buffer before you think about doing that. One other thing to ponder is that if you want to overpay your mortgage, because it is great to the idea of you owning your house sooner rather than later, and you do save interest if you do it on the whole, the one thing to bear in mind is that because it's secured debt, the rates that you pay on it are far more favourable than most other types of debt, like credit card debt or other unsecured debt. So you would be better off clearing higher paying interest rate debt than a mortgage debt. If you've got other debts, then stack them up in terms of highest to lowest, and you'll be financially better off trying to clear those debts before you then start pondering clearing your mortgage, if that's what you want to do. Because I know the argument is that people who tend to start wanting to overpay their mortgages, they're getting nothing on their savings, or hardly anything, so therefore by paying off their mortgage they're actually being better off. But don't forget those higher interest rates on other types of debt. Now, if you overpay, it can make a massive difference on the amount of interest you pay on your mortgage, and you could even theoretically pay your mortgage back earlier. But the key message is to check the T's and C's of your mortgage contract, because many of them will have early repayment charges, and that's particularly if you've got a fixed deal, so you're having a fixed rate for a period of time, or some kind of discounted deal. Now, if there's an early repayment charge, that can be often a percentage of the overpayment. Some average figures, it can be 3 to 5% charge, and if you then put that on, that can be quite punitive. That could make it so it's actually financially not a good idea to start overpaying. So you have to look at when there are early repayment charges, and more importantly, look to see if they ever decrease at some point or are removed, because then that will change the whole dynamic. Now, a lot of mortgage lenders know that people want to be able to overpay and allow flexibility. So typically, you'll see limits of about 10% a year that you're allowed to overpay. So that's 10% of the outstanding balance on your mortgage a year that you could overpay. That can move up to like 20%, or they could have a monthly limit of a monetary amount, say £1,000 a year or something similar. So find out what those limits are, and again, sticking within those limits will likely mean you won't be penalised in any way. So if you have a lump sum, it may be that you have to just start overpaying in small amounts to keep within those limits so you don't get penalised. You're dripping across, and you're putting the money elsewhere to use in a savings account, which then throws up the other idea that you could consider an offset mortgage, which is a mortgage where you have a savings account and a mortgage. And let's just use a very simple example. If they were of exact same size, then the interest that you would have got on your savings offsets the interest they would charge you on your mortgage, so it saves you interest in the long run. So that is an option. But as always, go and speak to a mortgage broker if you want to have a look at another type of mortgage. But in the first instance, if you're looking to overpay, find out what the terms of your mortgage contract are, or speak to your mortgage lender.
Good stuff. So moving on to the last piece, and there's a big piece in the news this week, specifically targeted at Amazon, and which did a big survey saying that basically there are lots of products being sold through Amazon, through various different marketplaces and sellers, where fake reviews are being posted. And as a result, people are getting confused. They don't really know what they're buying. They can't work out why there's lots and lots of reviews for what look to be poor quality products or potentially fake products. So it was an interesting story, really. And the idea of this piece really is to highlight what a fake review is and to see if you can spot one and what you can do about it.
So I find reading reviews time-consuming but also irritating.
No, you don't. You find reading reviews very entertaining. We read some brilliant reviews of some broken biscuits.
We bought some broken biscuits in the office, and this is a good example of reviews online. So we bought some broken biscuits. If you remember the broken biscuits back in the day, that was literally a box of broken biscuits.
Swept off the factory floor.
And you can buy them for a couple of quid. And I saw them at a birthday party that I went to with one of my children, and I said to the office, "We got to get some broken biscuits." Now, Iceland sold a box of broken biscuits. Yeah. I remember my nan used to buy, so we went and got one. It was amazing. But of course, we were looking where to buy them, and we were reading online. I found it, and I was having tears come down my face, where people were writing negative reviews about a box of broken biscuits, saying it was just a box of effectively broken biscuits.
Yeah, I can't believe my biscuits are broken. I seem to only have the halves with no cream.
Yeah, and it wasn't even the fact that they weren't being funny. They weren't even trying to be sarcastic. Yeah. They were just actually genuinely annoyed. One person complained that they had all their broken biscuits. All they had was the custard cream with the one side with the cream on, which if they thought about it, there was someone elsewhere that had a box of broken biscuits with custard creams with no cream.
Yeah, and so they're winning.
They were winning, and they complained. But so is the riddle of reviews, the way you have to go through them and just look at who is writing these reviews and why. Now, Andy was saying about this piece, there are loads of fake reviews. And what was interesting is it seems like lots of them are coming from abroad. Is that right?
Yeah, so lots of them are coming from abroad. And the Which Report particularly highlighted that they found out and been able to speak to people that are actually being paid to essentially write good reviews. So there's a few tips on how we as consumers can try and spot these fake reviews. So there's a few tips on how best to stop these fake reviews. And so don't rely on the ratings themselves. You need to delve a little deeper. Read the actual content. Sometimes, and I'm guilty of it, I'll just look overall and I'll say, look, 4.6 is the average and there's 250 reviews. That's good enough. Well, actually, what we're saying here is that actually isn't good enough anymore. You've got to delve a little deeper. Make sure that there's some descriptions on those reviews. Read them. Check for repetitive content. If it's the same review that's being posted time after time, that's likely literally being copied and pasted and people are being paid to put their name to that review. Look for poor spelling. That's a very good example that it might be being posted from abroad. A really good tip is actually to filter the reviews. Now, people might not know. You can go onto Amazon and there are probably other sites that do a similar thing. And you can actually click a button that says only look at what they call verified reviews. Now, a verified review is where Amazon themselves can actually rubber stamp it and say this person has actually bought this product. So it's not just you or I that can go on and say, yeah, this is great. You have to actually have a buying history that's linked to your Amazon account, which can be traceable to that person. So there are ways that actually sellers can get around that by providing the products to the people and linking it to their accounts. But in the main, if you're filtering via verified reviews, you will get a better selection and a better idea of what it is that you're actually buying. And really the last one is just to use your own common sense, really. If there's a million brilliant reviews and no bad reviews, well, that's not life. Life isn't like that. You need to look for balance. If there's literally no bad reviews at all, then I would question it. Use your own barometer of what you think is good, and
Yeah, and I have to add to that. I do this. If I go and buy something, I look at the overall score, and then I go and deliberately filter the good and the bad. So I want to look at what is it people hate. And there's nothing more infuriating than when I read Amazon where somebody goes, "Oh, I ordered this and the person delivered it 2 days late."
Yeah.
Well, that's not their fault. It's
they
the product.
gave it to my neighbour.
They gave it to my neighbour, or they threw it over the fence and it's broken. Well, that's the delivery company. That's not the product. So you've got to look at those. And if all the low scores you can live with, then it's the same as TripAdvisor. They have the same issue. If the things that people are really moaning about you can live with, then you realise that gives some context to it, like the broken biscuits. Someone who was buying broken biscuits, expecting to get broken biscuits, the fact there were people moaning about the broken biscuits wasn't an issue for me, so I knew it was going to be what I wanted. So another thing I would add to what Andy said is that it can pay to go and look at independent reviews off of Amazon. So if there's a product in particular, like especially electrical products, there are publications that you all know that would carry out reviews independently. The journalists will write reviews. So if you can compare what they're saying versus what the people who use the products are saying, then if there's some commonality, then you know that it's probably overall going to be a generally good representation of the product. So if one says it's great and one says it's not, then it probably is something amiss there. But if they both agree generally about the state of the product and how good it is, then that's a good insight.
And look at the actual product description as well. And as Damien says, go outside of Amazon and check for that specific description, because there are a lot of fake products on Amazon as well. And they're aware of it. And it is the scourge of Amazon, especially with things like aftershave products and things like that. There are people that are selling products that aren't actually the real thing.
And on that, I just want to mention a story. I remember reading it. I think it was on the BBC. There was a guy who, I think he won the equivalent of the Dragon's Den. I think it was in America, something like that. And he created a tool that you basically stuck on the end of a hose, and I think it was be able to clean boots and stuff. So like wellies and things like that. Anyway, his product was successful. He'd marketed it. He'd produced all the packaging. Anyway, he'd sold it. What happened is someone from China... And this isn't stigmatised in China anyway, this is just a fact of what happened. In China, they copied what he'd done, and they'd even replicated his packaging with his face on, exactly the product, but used cheaper materials and sold it online through Amazon for cheaper. And what happened is he only got wind of it because he started getting loads of bad reviews and complaints, and the products were being sent back, and he was looking at them going to replace them. Then it dawned on him that the products weren't his products, they were low quality versions. And this is where it came up about the fact that Amazon doesn't verify that everything on Amazon is authentic. So just because you get great reviews, the product is cheap, it might not necessarily be the genuine product. So the only way to possibly verify that is to look around to see if the product is widely sold in lots of different places rather than just by the manufacturer themselves. But there you go, Andy. I think that's it. We've covered everything, a lot in one podcast.
We are done. So if you want to get in touch with Damien, it's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. Search us on Instagram, lots and lots going on there. Don't forget about the mug competition. If you want to get involved, get in contact with us. Tell us what your mug-worthy thing is.
And the final thing, and I hope people haven't switched off by this point, is that when I went to the recent Habito event, someone took a picture of me with 5 other people, 5 other followers, podcast listeners, and they took it on their phone and they said they were going to send it to me, and I can't remember who it was. I've been trying to track them down on social media and I've gone round and round in circles. So if it is you, please send it to me via email, because that would be fabulous.
That's Damien at moneytothemasses.com. We are done, and until next time.
Until next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.